I'm trying my best in this episode not to get too deep into it, because I'd rather just try to sprinkle the ideas for you to take to people, because there's a lot of compliance, a lot of rules, just a lot of complications, and I'm not expecting you to understand it, but I think just being familiar with the concepts and the ideas of how this all impacts you, and that's going to lead you to start proactively starting the conversations with whomever is in your kind of pocket of professionals, because just laying there and kind of taking it and being reactive is what is kind of going to cause your pain, because the worst thing that comes out of this is at least being prepared for what's going to happen, even if you don't find a huge savings somewhere.
Yep.
But just knowing what it's going to be on a regular basis at least lets you prepare and plan for it, and use the business to help fulfill the obligations that you have from a tax perspective.
100%. Hey everybody, and welcome to another episode of the NextGen Strategies Podcast. Joining me as always, Tyler Davis, and we're going to be talking, shocker, a little bit about money and taxes today. We have a little bit of a pivot though, because I'm the one wearing green. Tyler is not wearing green today, so I came ready to talk today, and I think Tyler, you've got a whole lot of stuff that we're going to cover for a lot of different situations when it comes to business ownership and things to be considered around tax time and their entities and all other things like that.
Yeah, we've talked about tax, quite a few times, but I think we've been very much geared towards very much basics and a little bit more on the entry level of business ownership. And I think this topic kind of got spurred based on lots of conversations I have and lots of conversations we both see in the space of some of these more established businesses, especially as they bring upon new owners and the challenges these new owners have to face about, well, what are all these taxes and forms, and what can I do?
Structuring and like, is this a CPA problem, a legal problem, a mix of both, something not? Yeah, exactly.
Absolutely. So, I think the thing to think about here, and I think is always the starting point I always have with clients, it starts with entities. Mm-hmm. When we're talking about your business and how tax impacts it, we always start with, well, what type of entity is the business? And there's so much hearsay and bad advice out there about LLCs and corporations and God knows what. So I think it's a good place to start and really lay some groundwork on what's going on, because most people don't understand that there are basically the legal side of entities and then like the entities that CPAs talk about. And CPAs are very cognizant of not trying to talk about the legal side of entities, because that's for attorneys, and CPAs are not trying to practice law. But for the most part, everything everyone always hears is, oh, you got to have an LLC, right? And most businesses are some form of LLC. The thing to remember here, to ingrain in the back of your brain, is an LLC is simply more or less a state filing that you do that structures the entity of your business. And an LLC just on its own doesn't really change anything for tax purposes. For the tax side of the house, it's many times what's considered a disregarded entity. And when they say disregarded entity, it just means for tax purposes, we're disregarding whatever structure you have, and we're going to treat this as your personal tax situation. So, I mean, there are large businesses that are just simply an LLC, and they're disregarded at the tax level, which just means that you have a fancy Schedule C on your personal tax return that summarizes all the revenue and expenses of your business, and then you handle that personally. Now, I will say it's becoming less and less often that that's the case, because most CPAs are advising their clients to look at different types of elections their entity can do for tax purposes. And those elections typically are an S corporation or a C corporation. And then there's also, anytime you start a business and file an LLC with multiple owners, that's automatically considered a partnership. But you don't really see a ton of just strict partnerships anymore. You mainly are seeing C corporations and S corporations, and predominantly S corporations.
Now, why would that be? Because you hear, and maybe that might be confusing a little bit for listeners too, like you hear the word partnership a lot, but as a entity, or as you're talking about, like tax-wise, it's not considered in your world, the partnership model.
So if you have like a little chart here, in businesses,
We'll put one up here. We'll put one up here in editing.
Let's just say it's XYZ business, right? And XYZ business files LLC. So now it's XYZ LLC. Depending, there's two roads, right? Depending if that business has multiple owners or not. That's how the roads start. So if it only has one owner, then it's considered a sole proprietorship. And that goes back to what we said before. If you do nothing more, that falls to you on your personal taxes. It's done on your personal taxes. Now, as soon as you file an LLC and have multiple owners, you have a partnership for tax purposes. The partnership can decide if it wants to elect S or C Corp status for taxes, as well as the sole proprietor can elect S or C status as well. So those are statuses that CPAs recommend primarily for their purposes surrounding tax and tax planning. Now, attorneys will also recommend different types of entity structures as well for the legal side of the house. That's just not something that I dive too much into, because there are different pros and cons that you've probably researched before too about your liability essentially with a business and how things are structured. So I hope that's as a basic of a way I can explain that. Most of the time, whether you're in a partnership or you're a sole proprietor, a lot of times you're making an S or a C Corp election.
Yeah. No, I think that's really good. I think it's a good starting block for some of the things we're getting ready to talk about.
Yeah. And the S Corp thing has been predominantly popular since its creation, because what you see with a C Corp election, a C Corp is what you would see as most major significant large businesses are C Corps. So any of your big ones that publicly trade most of the time are C Corps. So take your Ford or your Apple or this or that. They have their ownership structures of shares of the C Corp. And you didn't see a ton of advising down the C Corp route, because that's where you see the term that's coined double taxation, because C Corps are taxed. The profit that the business has itself is taxed. And then if they pay dividends to their shareholders, the shareholders pay dividends as well. So you see a little bit less in C Corps, but I think it's starting to become a little bit more popular because there are some advantageous tax treatments for C Corps right now, and it really just depends, and we can talk about that a little bit later, the nature of your business and how you're trying to grow it and what you're trying to do, where that can make a lot of sense to be a C Corp. But like I said before, S Corps are predominantly advised for these businesses, especially like your small town USA, Main Street businesses, because what it does is it allows, especially in the beginning stages of profitability, owners of that organization to save a little bit on self-employment taxes. You'll see that a lot. You've probably heard that if you talked to a CPA before. It's a common suggestion to save a little bit there on those S corporations.
Yeah, for sure. And I know, probably a majority of our listeners would be looking at something like that, or they would be, already in one. So I think that's great. So let's talk a little bit about maybe the nature of S Corps, or maybe, folks will say, well, should I be, if I'm an S Corp or a 1099, or what are some of these different things that go into, what is it to starting to consider on that?
Yeah. Predominantly, the natural progression is that once business owners start making, I would say close to 6 figures or more in their business personally, or the owners are, that there's several of them, they start thinking about an S Corp election. And what that does is you're just indicating to the IRS, my LLC is going to be taxed as an S corporation. And that then brings rules that you have to follow. And the biggest one that the owners fall into is they got to put themselves on payroll. Many owners like that because it is an opportunity, because IRS says you have to pay yourself what's known as a reasonable wage. You can't pay yourself $5,000 a year to do the CEO job. You have to pay what a CEO would make to do that job. Mm-hmm. Business owners like that because it gets them on payroll and they kind of get a steady check coming in. And then the tax advantages, like I said before, are whatever you are paying yourself as that reasonable wage is what's subject to what we love to call FICA taxes, which is Social Security, Medicare taxes, things of that nature. And then any additional net profit that the business has that's passed to the owners is just taxed at regular income tax rates. So that does save in a specific scenario where total income's below the typically the Social Security threshold, which is right around $170,000 a year, some level of tax savings. And it just kind of starts to make your business feel a little more real because you're like, I get W-2 now out of my business, right? But I think one thing to really focus on here is a lot of business owners are not stepping through this thing like the business owners who just created their business last night and have grown it over the last few years and have made these elections. A lot of times you come into business ownership either through acquiring a business through purchasing it or acquiring ownership in a business through earning it as if you've been identified as someone in, say, succession planning. So that can kind of just throw you into the wind of these entities and taxes that you have to deal with and structure overnight, and you haven't had the time that some business owners have had to kind of learn these things. And Grant, this stuff's complicated. Mm-hmm. And it's easy for me to rattle it all off because I deal with it every single day, but it takes years and years of just hearing your CPA talk about it before it starts to set in and start to make some level of sense and you start to kind of get in a groove with it. And what's really challenging is when you come into an existing business that's of substantial size, and even if you get a 10% stake in the business, all of these things are coming up and serious tax ramifications can happen. And you wouldn't have all of this luxury of kind of learning these things over time,
Right. Yeah. And I think, like you were saying earlier, like Ty and I have had so many conversations with some businesses that are kind of in this transition phase right now, or folks who, either from the owners who are looking to, maybe move the businesses to children or succession planning, or they're owners who are looking to acquire another business entirely. Like they're not getting out of things. They're just looking to expand. Or we've had those conversations with the folks who are on the other end who are like, yeah, I'm trying to buy into this business, or, I'm also looking to do X, Y, Z. So yeah, I think there's, to your point, there's a lot of learning, and again, as the non-CPA guy here, who's been on his own for 3 years, like there's just a lot of terminology and a lot of kind of whirlwind until you go through it. And so, I know a big piece of what we want to cover today is really going through like maybe what some of these scenarios might be in terms of the successions or the transitions, and like what are some maybe things to look out for, or maybe some considerations to make. And I think you touch on maybe some of those pain points folks might be having. Yeah,
I'm sure I've already lost some people, right? I mean, and it's so easy because it's just terminology. Right. But I'm going to try to get a little bit more practical with it because, I didn't say it earlier, but this is becoming more common too because of how much private equity is entering small business. And typically what you see when like private equity comes in, you could see it, let's call it an optometrist office where you've just owned this thing or you've owned it with different people. If private equity comes in and buys it, and then all of a sudden you still retain some level of profit sharing or interest in the business, now all of a sudden it looks way different. And these things can just happen. Or you've been this employee who's worked at this business and you've been identified as, someone who may take the reins one day, and you're buying an interest over time, or you're doing a purchase acquisition right now and you're using a little bit of debt to finance it, or you've got a 10-year buyout with the owner. These things just come up and they happen. And usually what happens is no one really understands it until about February, and they get this thing called a K-1 in the mail, and they're like, what the hell is a K-1? And what is this, and what does it mean for my taxes? Yep. And I think the overwhelming situation that occurs is that people are not prepared for paying taxes on what shows up on those forms, because it usually doesn't line up with like money they've actually seen enter their bank account. And I kind of want to break that down in a real practical way here. Typically with, S corps and partnerships, you're going to get a K-1. A C corp, you would get like a 1099 dividend, but fundamentally kind of the same thing. And it's going to show you your share as an owner of the profit of the business. And that doesn't mean that's what you got out as like a dividend or an owner's draw or payout, because simply at the end of the year, the CPA is going to do a tax return for the business and look at the P&L of that business, the profit and loss statement, and say how much money did this business make, net income. And then it's just dollied out to the owners based on their percentage of ownership. And if you know anything about your accounting, there are items that happen that aren't on your P&L. They show up on your balance sheet. Those are, paying out owners. Those are large equipment purchases. Those are debt-related items. So sometimes, a common example would be if you're reinvesting into the business, buying inventory, buying large pieces of equipment, that money may never made it to the owner's pockets of that profit. But then you're sitting here with a tax form that's going to generate additional taxes for you to owe. Another very, very specific example of how this plays out is if you're in the mode of acquiring a business, especially in a purchase agreement with an owner. As you're acquiring that interest, you're paying for it in some way, shape, or form. Either you're using outside financing, maybe it's in lieu of wages, or some of your wages are going back in, or part of the profit, your profit share goes back in. You're never seeing the money, but you're still responsible for that portion of profit of the business. So what ends up happening is you're kind of paper rich according to the IRS, but then, bank account poor. And it can be a really, really challenging time for the individuals who are going into this ownership because they probably lack a controlling interest in the business. So they're not really calling all the shots a lot of the times, especially when it comes to reinvestment and equipment purchases and how these structures go. And sometimes they're just so excited to get business ownership. They're signing whatever legal agreement comes their way and they're ready to go. And they get pinched really hard. And it's something to really consider. And I think we'll talk about this a little bit later, but the common thing I see is that whomever was doing like the taxes or helping out for the business, that individual who's coming in ownership is using that same person. And I'm not saying that's wrong, but what you have to consider is you probably should start thinking about professionals to have in your life that are thinking about you and your interest and what's going on. Because if an accountant's been working for a legacy business for all these years, there's a lot going on, and they're really looking at this deal and making sure it's working for majority ownership and the business and all this. And it's kind of hard for them to, think about your situation too. And I'm not saying they can't, and firms have the ability to do that. But I think for you should focus on making sure you have someone who's thinking about how it impacts you and maybe things that you could be doing before you sign documents or, whatever to protect your financial situation.
Yeah, for sure. And I think you just, in about 3 minutes, covered topics that we could go like an hour each into those. But I think that's a really good way of distilling through what you think may be, simple math on, like a P&L sheet or that you're used to seeing is like there are a lot of ramifications to like understanding that you are responsible to help pay the taxes on the shares that you have from an equity standpoint. However you need that, and you correct me if I'm wrong, but like the IRS doesn't care. Like somebody needs to, you are responsible for that obligation that comes through that K1. And so you just have to be planning, whether that's, yourself, trusted advisors, like you have to be ready to kind of plan for that and adjust whatever it is, your personal, your personal, spending habits or like understanding, with the current majority business owners, like you just have to be able to make sure you're accounting for that so that you're not blindsided with that February, that what comes at the end of the year.
I think very commonly minority business owners, when I say minority business owners, I mean like you don't own over 50% of a business, are very much operating in the blind on the performance of the business from a tax perspective and how that's going to impact them, because they may not have a professional that has the optics into that. And there are all kinds of different situations that go on, and I'm not disparaging like existing owners or other CPAs or anything like that. It's just a thing that just happens on the sidelines no one's thinking of, and then it hits you at tax time and then you're scrambling, right? So I think that's the imperative part, is how can you get access to the information that you need to know and how it's going to impact you. And there are lots of different structures that handle this well and don't make this a big issue. But what I find is that your typical kind of like, attorneys and CPA firms and doctors' offices and places that have had like this succession planning in existence for years and years and years tend to do this really well because they've seen it numerous times to partners over time. But a lot of these businesses that they don't have the luxury of all that knowledge. We said it before, like
Right.
An owner's owned a business for all of these years, and they hired this, young person to come in and take over the reins one day as part of their exit strategy and part of a big, exciting opportunity for this new owner. And no one's done this before. And, there are things that can be done, proactively to make this not such a crunch for the new business owner. And there's a lot of stuff for the exiting business owner, too, to think about as well. So that's kind of my gist. I don't want to get like crazy deep into how it impacts you if you're a C Corp or if you're an S Corp. Like you said, we could go on and on and on. I think the predominant thing is understanding the obligations that you're signing yourself up for with ownership in these businesses, and then having people to help you navigate that. And then by golly, try to understand it. You're not going to understand it year 1, year 2, year 3. You're going to get a little bit each year, but by over time, you having a fundamental understanding of it is going to help you, A, select appropriate professionals that have in your corner, and B, make better decisions as time goes on.
And I think one of the, you've said this multiple times on this podcast, and, again, as the person who's, not CPA, not always in, tax and finance and stuff, like there's a lot of bad advice out there, and a lot of what, so somebody like me, right? Like I like to try to go find, either follow folks on different social media channels, etc. Watch a lot of YouTube videos on this stuff. Like, be weird. Just watch out for the ones that are always saying like, because this saves on your taxes, or this is a tax hack, or you should do this, and this because it does this and this. Like, there's multiple different ways to be tax efficient. And if you've got a good professional who's helping you with that, like you're going to get there, but you need to first just understand just what you're saying, like the definitions and how it flows first. Don't worry about how quick you're going to be able to maybe necessarily save money or what you're going to do with your taxes, because like if you don't have an firm understanding of just the definitions and the flow and how that stuff works, and then you're going to be way more confused if you then start trying to figure out, well, like, oh yeah, well, what if I heard if I did this and this, I could save my taxes. Like, slow down, like not saying yes or no, but you may be able to, you need to understand kind of point A before you get to point B, I guess.
Yeah. I mean, I think we have it here in the notes that you need to put together kind of like your financial board, or like your people that are in your corner. And we talked about that. And I'm here to say there are so many different flavors of that. I mean, there are bookkeepers and accountants and enrolled agents and CPAs and fractional CFOs and God knows all kinds of different professionals. And I think I'm here to say that there are significantly different flavors of professionals. And I'm sure it's very similar in marketing, as wide as it is. There are people that are really good at certain things. There are people that are really good jack of all trades in certain industries.
Yep.
And I think I touched on it a little earlier. The mistake that I see is that, maybe a business has been in existence for a long time and they've used the same CPA for a long time. The thing that you don't think about is if it had tens of years to kind of strategize and kind of get this business where it is. And a lot of times they're kind of on autopilot at that point. There's not miraculous new things every single year besides in, major tax law updates. So they're dialed in, and that other owners had all this time to understand it. And, you coming into this situation and just utilizing this is how we've always done it situation can be tough for you. And I think you should, like I said earlier, start looking for people who represent your interests, and that comes in lots of different flavors. And I'm here to say there are CPAs out there that are really, really good at filing tax returns, and they don't really have the time to do a lot of proactive planning, because that's how their business is structured, is to do significant volume of tax returns, and they do a good job of it. But, this type of stuff we're getting into gets complex, and you need someone who has the time to think about how these levers affect you and think about it during the year and not in March. Predominantly, the natural progression is that once business owners start making, I would say close to 6 figures or more in their business personally, or the owners are, if there's several of them, they start thinking about an S Corp election. And what that does is you're just indicating to the IRS, my LLC is going to be taxed as an S corporation. And that then brings rules that you have to follow. And the biggest one that the owners fall into is they got to put themselves on payroll. Many owners like that because it is an opportunity, because IRS says you have to pay yourself what's known as a reasonable wage. You can't pay yourself $5,000 a year to do the CEO job. You have to pay what a CEO would make to do that job. Business owners like that because it gets them on payroll and they kind of get a steady check coming in. And then the tax advantages, like I said before, are dark magic and make your taxes go away, right? And really, it's on both sides. It's finding a professional that has the capacity and wants to help you on some regular interval. And that doesn't have to mean weekly, monthly. It can mean quarterly. That's there really understanding the situation you have going on and you doing a good job getting that information to them.
And I think sometimes too, and I know you've probably seen this and worked with folks, like there are advisors out there who can are mergers and acquisitions advisors who can help work with, kind of be that intermit or that, mediator of the different entities that may be involved in this. Like they can usually maybe sometimes ask a question maybe a little bit differently or say hey, we've seen this done in one or two different ways. And so, I think that sometimes might even be a relief for, the accounting side, the owners, sometimes just having that other person depending on your situation.
Yeah. I think this all comes down to size and scale.
Yeah.
If we're talking to you and you have this going on and you're acquiring a $1 million a year revenue business, I think you should be able to find a sole individual CPA who can walk you through front to back that situation, from the profitability of the business and giving you advice there to your tax implications to the exiting owner's tax implications, and do that well. But if we're talking about a $30 million a year business, this is when we should start thinking about maybe some diversification in talent. Because we have big numbers and we can have big savings and we can have big, levers to throw here. And when I'm thinking about business owners in this situation, you just have significant flavors of talent in the pool. You hear, a lot of people when we talk about it, like fractional CFOs. Fractional CFOs, some of them can be, just amazing at scaling and making your business more profitable. But they don't want to touch anything to do with taxes. There are some that are really good at tax and pretty darn good at, the profitability of business and scaling, but they're probably not that on your $30 million a year business. They probably are for your maybe $1 million, $2 million a year business, right? So, one of the combos that I like is if you're in this situation, having a good fractional CFO that knows your numbers really well and can help your business make more money, that's going to help you a lot in this situation, because making more money pays taxes easier than just trying to get rid of taxes. Yep. And then also having a really good CPA that's been there, done that on these larger businesses, and how that merger, acquisition, succession planning is going, and you can pair those two together. That's a great idea, right? Because just remember that, just like you as a business owner, there are things that you're really good at. The finance professionals are the same, and as you go up in complexity, some separation of duties there can pay dividends to you.
Yeah, absolutely. And we've covered, again, without trying to go too much in depth of these certain items, we've covered quite different things, from entity structure down to maybe some scenarios of transition or ownership or acquisition. What are maybe some of the other, maybe I don't want to call it, tips, tricks, things to think about, as you're going through these processes from a tax standpoint? What are maybe some of the high level things that you should also be considering in addition to these things we've already covered?
Yeah, the first one that's closest to what we've been talking about, that can about apply to anybody. But if you are acquiring a business, whether you are an existing business buying something, a competitor or someone in your space, you're a new business owner acquiring an interest in a business, the key thing to keep in your mind here that's not very complicated is that what you're paying for the business many of times is not deductible. And I want to explain that again. Say you're buying a business for $1 million. That $1 million that you're paying for is equity that you're buying, and is not necessarily deductible in the way that you think would work in your mind. It really depends on how the deal is structured, what is goodwill and what are asset purchases, because each of those have different treatments for tax. And that's what causes a lot of this pain that we were talking about earlier, is that people will buy a business that doesn't have equipment and stuff like that, and they got $1 million in goodwill wrapped up in it, and they're shelling that out every year. And the example is you buy $1 million business, and it does $500,000 in profit, you still got to pay tax on $500,000 in profit. You're not getting whatever you were paying for that business as a deduction against the profit of that business because it's your equity in the business, right? It's a little different, and we can talk. I have some ideas here about, structuring deals, because if they're heavier in assets right now with the new tax bill, it's kind of permanently set in 100% bonus depreciation. So if the deal is more geared towards assets, it allows you to deduct the purchase of those assets just like you were buying them brand new.
And why don't you explain a little bit, like, what, when you're saying assets, like what maybe falls underneath that category?
So like a good example is like if you buy like an insurance company, they're not going to have a whole lot of fixed assets. They're going to have, unless you're buying the real estate with the business, what are they going to have? Maybe some office furniture and some computers that are probably don't have a whole lot of value left in them because they've been, they're wear and tears on them. But if you're buying a, let's say, manufacturing company who has a $2 million CNC machine,
yeah,
right? You have the opportunity in that business acquisition to say, okay, we're buying this company for $10 million. $6 million of it is hard assets, like a CNC machine, like a big old press, something like that. And it's not all goodwill, because on the insurance company example, you're buying the brand. You're buying goodwill is what they'll call it. It's an intangible item you can't put your hands on. Versus some of these other businesses, they actually have investment into assets that produce the income. And you can kind of, I don't want to call it get creative, but even on these businesses that are more substantially in goodwill, there are assets there. You just got to find them, and you have to determine if the real estate's involved and stuff like that. But the more assets that you can find tends to make a better tax situation for the acquirer. But I see that mistake happen a lot too on smaller, like manufacturing style companies, where they don't think about, dividing the sale between assets and goodwill, and they leave a lot of tax advantages on the table because they didn't bring someone in to help them kind of identify that, because it has different, impact for the seller versus the buyer too. So that one's the closest in line to what we're talking about, and then why it's important to bring people in, attorneys and CPAs and of that nature, before you sign purchase agreements, because it has an impact on you and it's part of negotiations. Other things to think about, especially if you're like, Tyler, I've already acquired the business. Like, I'm trying to figure out how to save now, and when you start getting a business that has, a substantial size and you have employees, it's really easy to forget about little odds and ends that can kind of stack up. One of them being like just simple tax credits. I don't call them simple. They're complex in nature, but there are professionals that'll help you with that. And you know of one that you just kind of recently came across. But one that we've talked about recently, even with another CPA, is R&D tax credits. Those are interesting because they can actually even help offset payroll taxes, which those FICA taxes you pay for employees. And there's some new ways to kind of get into those R&D credits now that were harder to get into before, because R&D credits really are research and development, and a lot of times they were kind of exclusive for manufacturing companies and medical companies and stuff like that. But now with the boom of AI and things of that nature, there can be some R&D that exists, and having someone who can understand and see if that's applicable for you could be some huge savings, right? Other items that relate to employees there are some tax credits out there for if you're considering retirement accounts for your employees, that can help kind of offset the cost burden of having to put up that match for your employees. So that's a double win, just because it can help make it more cost neutral, but also help with your retaining talent. Did you want to talk a little bit about the one that you learned about?
I do not, because I will butcher it. You talk about the WOTC?
So if you pay attention, like, this is what happens when you start to hire a lot of people. Hiring certain classes of people and individuals can provide tax incentives, especially if you look around people who are coming out of incarceration, people coming out that are veterans, things of that nature. There are programs, not only federally, but a lot of times state level programs, all wrapped around who you hire, how you train who you hire, that can be really rewarding from a tax credit perspective. The one you're referencing is the federal tax credit that applies towards payroll taxes for hiring individuals that are in these different classes. But there are also a lot of state level programs. Like in Ohio, there's a state level program about, basically developing your workforce and getting tax credits back for things you might already have been doing anyhow in terms of education and programming that you're doing for your talent. Those things can make a huge difference to that tax bill that you had coming. And what I always like is if there were expenses you were already going to have anyhow.
Yeah.
Those are some right off the top of my head. Some easier ones that just people forget about, and it's probably wise to have some level of financial advisor in your life. Really maximizing and taking advantage of different types of retirement accounts and how they work for you as an owner versus all of the rest of the people on your team. When deciding what type of retirement plan to use, every single flavor of them has different amounts that the owners can put in versus employees, and different amounts that you have to put up as match. And that starts to let you really sock away a lot of money for your future and not rely on just selling your business for your retirement. I think we had an episode about that.
Yep.
Simple things like HSAs. I think we had a conversation with a group of business owners about how you shouldn't use your HSA to actually spend on medical expenses. You should just treat it as a retirement account, essentially. Those types of things all come together with what I said before is like, do you have the right professionals involved? Are they talking to each other, and are you proactively planning anything?
And I just two quick things on that. One, you all should have saw Tyler's face when I heard about this WOTC tax credit in a conversation I was randomly having with somebody the other day. I'm like, I've never even heard of that. That's interesting. You're taking advantage of this. I said to Tyler. Tyler looks at me and goes, I feel like you were a little impressed that I even knew
absolutely.
What that.
Well, some of these are hard for CPAs and even keep up with, and I think the point on that one is that is becoming prevalent because a payroll provider you're connected to is really trying to educate their clientele on it. And guess what? They're so involved in payroll, they're going to see these things a little bit faster. You'll hear people talk about it all the time: tax programs, tax law, tax credits, 10,000 pages plus, right? So it is that diversity of professionals that you have in your life can help, because the CPA is going to be in charge of making sure it's filed compliantly, but sometimes they don't have the capacity just to be just mining through every single client they have and trying to figure out every single little thing that they could do. And you being educated on it, having other good professionals in your life that can clue you in on it, then bringing that stuff back to that team is what's going to really help take advantage of things. Another one I had on here, we talked about this one on another episode, but it got enhanced a little bit with the OBBA, which is the new tax bill. Why C Corps are starting to get a little bit more popularity too, and especially as you talk about buying a business, even if you're already existing business, like buying someone in your industry or you're a new business owner, buying into a C Corp could be an interesting idea, especially, and this is the specificity of it, is if you're interested in buying a business, growing that business aggressively and selling that business, because there's a little subsection that if you do all the rules right, if you form it as a C Corp and you grow it for 5 years, when you sell it, you can exclude most of your capital gain or tax liability in that profit from selling the business. And a lot of people don't like C Corps because of that double taxation thing we were talking about. But if you think about the context of this business that's trying to rapidly grow, most rapidly growing businesses aren't leaving a whole lot of money on the bottom line every year, and they're reinvesting back in the business. So you're probably not going to have the double taxation thing going on. You're doing the Amazon play where you take every dollar you got and shove it back into the business and grow the value of that business. So that's an interesting one to keep in mind anytime you're coming into acquisition of business, because that could save, just a serious amount of money if you're thinking about more of this flipping idea of a business rather than I'm just going to be working in this thing for, in the next 30 years.
Awesome. Yeah. There's so many different things to consider when it comes to just understanding business structures, understanding tax, the different implications that come with that. How, if you're an owner and you're looking to get, sell a business, or if you're somebody who's looking to, start your own business or acquire an existing business, like it's overwhelming. It can be a lot of different things. And I think if there's one thing to take away from this that we've iterated a couple times is like, make sure you've got the right professionals in your corner, the right, you could also be in a group of other, business owners or entrepreneurs or whatever. Like, the more you can talk about things, the more you can stay up with things, like, and it's always going to be changing. Tax rules change and, everything else. And I think that, making sure that you have those right people in your corner, staying knowledgeable, don't just rely on the advice from one person ever. You do your own research, is going to be very valuable, and just, being able to navigate this as best as you can.
Yeah, this stuff's heavy, and I'm trying my best in this episode not to get too deep into it, because I'd rather just try to sprinkle the ideas for you to take to people, because there's a lot of compliance, a lot of rules, just a lot of complications, and I'm not expecting you to understand it, but I think just being familiar with the concepts and the ideas of how this all impacts you, and that's going to lead you to start proactively starting the conversations with whomever is in your kind of pocket of professionals, because just laying there and kind of taking it and being reactive is what is kind of going to cause your pain, because the worst thing that comes out of this is at least being prepared for what's going to happen, even if you don't find a huge savings somewhere.
Yep.
But just knowing what it's going to be on a regular basis at least lets you prepare and plan for it, and use the business to help fulfill the obligations that you have from a tax perspective.
100%. So, well, everybody, thank you again for joining us on the NextGen Strategies Podcast. Until next time, we have a couple of great interviews that we'll be dropping here very soon that we're super excited. Until then, we'll see you later.
Thanks for tuning in to the NextGen Strategies Podcast, where we share real stories and practical strategies to help you grow your business. If you enjoyed today's episode, be sure to follow us wherever you get your podcast, and don't forget to like and share it on social media.